Remember the days, Maggie, when 1% growth was knocking on the door of recession? Well, the first half of 2025, we have 1% growth. If the Atlanta Fed is right, and that we'll see 2.5% growth in Q2, because that follows minus 0.5% in Q1, and averaging that together is 1% annualized. So yeah, we're knocking on the doors of one.
Hello and welcome to Wealthion. I'm Maggie Lake, and joining me today is Peter Boockvar, the CIO of Bleakley Financial. Hey there, Peter. It's great to see you.
You too, Maggie. How are you?
I'm okay. So much for thinking anything was going to be quiet this summer, because right away, again, we seem to be in a situation where there's headlines flying about tariffs, maybe new ones, maybe we have deals. Every minute it's changing. Pull the lens out for me a little bit and talk to me about how you're feeling about the tariff situation in terms of what sort of impact it'll have on the economy and on earnings.
I don't know. I feel like I'm the only one who's worried about tariffs with the stock market back at its highs. It's almost like we had a period of time of pause, and everyone thought that maybe the worst comes to worst, we'll get a 10% blanket tariff, even though 10% is still pretty big. And for some reason, I don't think people are doing very sort of basic arithmetic when analyzing the tariffs. All I hear is, well, look at all the money we're taking in, and it hasn't been inflationary yet. Well, since when are higher taxes like a good thing? And I'm trying to explain to people that would listen to put perspective on the dollar amount of tariffs, and I need to emphasize that I'm for lower tariffs and lower taxes. And the world is upside down when Republicans are all for tariffs but want a low corporate tax rate, and Democrats are bashing tariffs but want a high corporate tax rate. Either way, it's a corporate tax, however way you want to call it. The U.S. government, over a 12-month period this year, even though their fiscal year ends, I think, either September or October, will take in about $525 billion of corporate taxes based on, the statutory rate of 21%, with some companies paying less than that. Well, if we had a 10% blanket tariff on $3.3 trillion of imported goods, not including services, that's on top of the $525 billion we're going to collect and tax, added $330 billion on top of that. And if we're going to have maybe a blended tariff rate of 15% instead of 10%, based on what we heard from the Vietnamese deal, and today South Korea and Japan 25%, and other Asian countries between 25 and 35%. And so if the overall blended rate is 15%, well, 15% of 3.3 trillion is about 500 billion. So you're essentially doubling the corporate income tax. I don't know why basic math is not being done, as I said, by the markets, and somehow they're thinking that's no big deal. And I'm for lower taxes, as I said. I would have loved a further cut in the corporate tax rate to further improve our competitiveness versus the rest of the world. But somehow people think that all our problems are going to be solved by tariffs, and I think it's dangerous, and it's flowing through into the economy. I mean, the Atlanta Fed right now is estimating Q2 GDP of 2.5%. That follows a minus 0.5% in Q1. So that means on an annualized rate, in the first half of 2025, we're averaging 1% growth. So I'm kind of worried here about the economy and its ability to withstand tariffs and the negative economic consequences of these tariffs, which will offset what I think is a positive within the tax bill that just got passed of encouraging capital spending through accelerated expensing and depreciation. We're basically neutering that with tariffs, unfortunately.
So it sounds like you're uncomfortable with where valuations are. Do you think stocks should be at this level if that is not priced in?
Well, valuations have been an issue for years. It's a question of when it matters. And I think if the economy rolls over because of these tariffs, then it's going to matter. It's hard to generate much earnings growth when GDP growth is 1%. So I think the level of nonchalance and complacency here, thinking that tariffs no big deal, let's just jam the market back to the highs, I think is pretty adventurous.
Adventurous. I like that. I like that turn of phrase for that. So one of the things,
Now we're enjoying it. We're long, but I'm trying to be careful here with in terms of the sustainability of this.
yeah, I was just going to say, one of the things that people point out is that, if you made that bet and you've been, which it seems like retail, let's use that term loosely, but institutions got short and retail were the ones who stepped in after Liberation Day and bought, and they're feeling pretty good about that decision. They've done well. Do you worry about risk right here, the risk profile, especially if it was driven by more of a retail population? Do you buy that, by the way? I don't know if you agree with that.
Yeah, I mean, I've read about that, and it's probably true. I mean, retail, it's been paid to buy the dip for seemingly forever, particularly since 2008, 2009, when we went through the negative interest rate QE regime, and it paid to buy every dip. So it's hard to fault something that has worked consistently. I'm just wondering whether we've reached sort of wise guy status with this just buy the dip just because we're down. I think it's important that investors should compare the February high. Now we're up about, as of today's close, we're up about 1.4% from that previous February high. So compare the fundamental backdrop today versus what it was in February. Now in February, it was before the tariff barrage. Now we knew that it was Trump's favorite word and we were going to get tariffs, but I don't think anybody imagined that we'd get them to the extent that we have. So that is something that people should sort of compare. Also, we know a major driver of growth in the markets the last couple of years has been the AI trade, and the AI trade is essentially getting a second wind here. I think that it's one of the factors too that's taking us back to the highs, and that'll be sort of tested when we get earnings over the next month or two to see whether this second wind was based on just a continuation of, okay, this is an exciting story, let's just buy the dip, or there's something fundamental to the continuation of the trade, and we'll have to see. I think that the Mag 7 trade is sort of has completely splintered for good, and that you have to really pick and choose the names in that group, and that group still makes up about a third of the S&P. So I think it's I use the word adventurous for those buying it, but I see a fragile, dangerous situation here with the markets at the levels and valuation they're at. But again, that doesn't matter until it does. But with the fundamental backdrop that I think is precarious with this 1% growth and this barrage of tariffs, that to me is just freezing corporate decision making.
If you have any questions about how to navigate the current environment, Wealthion can help connect you with a vetted advisor to get a free portfolio review. Just click the link in the description below or head to wealthion.com/free. There's no obligation, and it will just take a few minutes of your time. Again, that's wealthion.com/free. Thanks so much for joining us. Yeah, I was joking when I said I like that turn of phrase, because it sounds like you're a lot more worried. It sounds like you don't feel like it's adventurous, that it is a risky time to be chasing things at this level. When you say the Mag 7 splintered, how are you feeling about that? Like, does it seem like there are some that are going to be able to continue to hold on to their leadership position, and then others that aren't? And what do you like and what don't you like here? I mean, I know a lot of people have been talking about Apple and are concerned about Apple. How do you break up Mag 7?
Well, the 7 has turned into 3, or I should say maybe 3.5. The half is Amazon. trying to figure out which way that story is going to go. Because on one hand, their retail business, as phenomenal as a machine it is, they're still sensitive to the vagaries and spending habits of the U.S. consumer, which is much more bifurcated and has been over the past year. But on the other hand, the AWS business, that's still robust, but seeing slower growth. Microsoft, NVIDIA, and Meta are sort of what's left of the AI tech trade, where Google's core business is being challenged. Tesla is sort of off in its own world, and Apple is just not growing anymore, but still trading at 30 times earnings. I think it's important to look at these stocks still because of as I said, the third of the S&P. How can you ignore it? But on the plus side, I think the market has sort of widened its lens of opportunities, and the advanced decline line is actually at a high. So that's the positive. Now, whether it stays there, I don't know, but the market has certainly broadened out, which is positive. The sustainability, we'll have to see. And also the market's broadened out its lens globally, with international markets well outperforming the U.S. markets this year after many years of underperformance.
So talk to me, we'll go back and talk about that broadening out and a little bit more on U.S. equities. But since you bring up the rest of the world, talk to me a little bit about that, because we saw a lot of people beating the drum about that in the wake of some of the early Trump administration moves. And you rightly point out Germany, Spain, some of these markets up in excess of 30%. It was a huge move. In your mind, is it just the beginning of that? Because at the time, it didn't seem like anybody was counting on the U.S. rebounding, but it did. And now U.S. is back at highs. And certainly I'm sure that there are some managers who were underweight that and who were not reduced their exposure to the U.S. just at the time when it had a rebound. Where are we in that narrative, and how much do you buy into that? How much are you changing portfolio allocations as a result of that?
I think the international outperformance is a multi-year thing. On a plain catch up in terms of closing some of the valuation gaps that we've seen that have gotten so wide. But also the weaker dollar is good for those markets if you're a U.S. investor. You mentioned the 30% returns overseas, particularly in Europe. A lot of that, almost half of it, is currency. So if you're going to invest overseas, you have to have an opinion on the dollar. And while the dollar is probably oversold in the short term and maybe due for a bounce, I think the dollar goes much lower. And a lot of that has to do with foreigners themselves that are losing money on a daily basis, owning U.S. assets that are unhedged. And also foreigners, not just U.S. investors, but foreigners that are saying, hey, the U.S. is not the only market in the world. And maybe we pushed our allocations a bit too far in owning those stocks, those being, the big cap names, because it's easy for them to own, and that it's time to look at other things.
So when you are, what sort of, everyone has to obviously talk to an advisor, which if you want a free portfolio review, please reach out, hit the link, or go to wealthyon.com/free if you would like someone to help you with that. But if people are looking at their exposure, listening to this and thinking, do I have enough international exposure? Is there a rule of thumb in terms of how much you should have exposure? Because it sounds like this is a generational, at least, change, or a multi-year change that we need to wrap our head around. I think most Americans have a huge overexposure to their home country and have not really had to worry about international stocks. The trade hasn't worked for a decade, and so are probably really underexposed internationally. What's the best way to think about, or what questions should we be asking ourselves, Peter, as we sort of look at our portfolio and try to figure out what changes we might want to make?
So there's not initially a magic answer in terms of what the right allocation is. We tend to have about a quarter of our equity exposure overseas, which has sucked wind for years, but finally is now working. I continue to believe it's important to invest globally. 75% of the world's GDP takes place outside the U.S. And I think it's important as an investor over a long period of time, you want to tap into that. Now, there's plenty of U.S. companies, of course, that do. So I don't want to make it sound like just buying the U.S., you're avoiding the rest of the world. There is a big chunk of S&P revenue that comes from outside the U.S. But there are plenty of good companies outside the U.S. And also, there's something also important. The S&P, the dividend yield in the S&P 500 is like getting close to 1%. So if you're going to see a return in the S&P, it's going to be pretty much all capital appreciation. Where overseas, there are just so many opportunities to get 3, 4, 5% dividend yields in solid, cheap companies that I think if you were in a position, which I think we're in the U.S., a period of a multi-year consolidation of it after extraordinary gains, and that there's going to be just a lot of chop around and churn in the U.S. markets as it sort of grows into this very high multiple, that's the case, you're not going to make any money in U.S. markets with that 1% dividend yield. Mm-hmm. Yeah, there'll be some situations like the 2000s where you're going to make plenty of money in individual stocks, depending on how good of a picker you are. But overseas, you can just sit and wait and clip a lot of good equity coupons at cheap valuations. But also you have some fundamental stories. I mean, Europe, of course, has gotten religion on defense spending, also the need and understanding the need to cut red tape and bureaucracy and from the regulatory standpoint, even though it'll still be a slow growth region. And, Asia to me is still an exciting place. I think when you look at China, it seems like their housing market just can't get any worse and is trying to find a bottom here, which I think is a big deal. Just saw some great Macau numbers. Yeah. India is still robust. And to me, Southeast Asia, Vietnam, and Indonesia are exciting places, economically speaking. So I still find opportunities there. And I just think that, the U.S. has had a nice bounce here off the lows. But, as I mentioned, since the February peak, it's up like 1%. I think there's a catch-up trade that is more than just 1 or 2 quarters. And that we're in a multi-year consolidation phase in the U.S., which means a lot more like this rather than a continuation of this.
So you mentioned the dollar, and I know a lot of people have been thinking about the dollar, especially relative to some of those Asian currencies. And I know you were in the region, so you saw firsthand what's going on with the economy not too long ago. Are you expecting continued dollar weakness? And is that in any way, can that in any way be destabilizing? Who are the winners and losers from a continuing dollar decline?
Well, I think foreigners are really pissed at us over the past couple months with this tariff barrage. Look at Canada, who was treated like this little child about being the 51st state, and a key trading partner of ours that we just slapped across the face with tariffs. In April, and we only have really data since April in the tick data, Canada sold $54 billion worth of U.S. Treasuries. I went back every single month that I have data on my Bloomberg, I think at least 25 years. I could not find one month that was anywhere close to that figure. And that was more than 10% of Canada's holdings of U.S. Treasuries that they just puked out in 1 month. So it's no coincidence to me that the Canadian dollar is stronger. And I think, as I said earlier, that I think foreigners are they want to own less U.S. stuff. They want to diversify not only their asset holdings, but their economies. And speaking of Canada, just the news of the last couple of days, how even Mark Carney, who is this tree-hugging, green-loving environmentalist that is now talking about sort of liberating the western part of Canada, and particularly Alberta, to allow them to pipeline oil and gas to the west coast of the country so they then can export that to the rest of the world. Whereas Trudeau and a lot of the environmentalists basically stopped that from happening, where a lot of Canadian oil and gas was landlocked to North America, and they were stuck selling at a discount their energy to the U.S. So we woke up the rest of the world to say, hey, guys, don't rely to the same extent on us.
Mm.
So if you're a European company, to use another example, and you source some product in the US, call it 70% of your needs, well, you're saying, well, I don't know how reliable that is. Let me lower that percentage to 50%. The US will still be a big trading partner of mine, but I need to make sure that it's less so. We certainly know China's been doing that. They're doing everything they can to rely less on us. But I think a lot of other countries are doing the same, and that could be a bigger picture negative for the U.S. dollar. And even Lula, the Brazilian president, I know there's a big BRICS get together. He even said, we need to figure out ways of reducing our reliance on the dollar system. So this is an evolutionary type thing. It plays out over time, but I think that over time, the dollar is going to be less of a reserve currency. 25 years ago, I think the dollar was about 70% of central bank reserves. Now it's down to about 58%, not including gold. If you include gold, that percentage gets into the high 40s. So dollar's still going to be important. It'll still be a reserve currency. But I think that there's the potential for bigger weakness here. And I'm watching now the 95 level in the Dixie, which is certainly euro yen heavy for sort of a next key level to look at. Now, maybe in the short term we're oversold. We could get a bounce. But this tariff war isn't making us any friends overseas. That's for sure. And
that's important for people listening, aside from the sort of macro and geopolitical implications, because it's potentially selling pressure, sort of persistent selling pressure on U.S. assets, because that's how people are expressing their holdings of dollars. So they will either sell or buy less U.S. assets. So you just talked about a stock market where earnings can be under pressure, margins under pressure, the economy under pressure potentially from what you see as a corporate tax in the way of tariffs, and less foreign purchases or international purchases of U.S. assets. That sounds like a sort of troubling mix. What are your expectations for rates here, Peter? Because in addition to selling U.S. equities or Mag 7 that they're overexposed to, U.S. Treasuries, you just mentioned Canada. What are you expecting on the rate side?
Well, what will be interesting to see, as we tape this, the 25% tariff on Japan, and Japan's the largest holder of U.S. Treasuries. If you're Japan, you got to question whether you still want to own all these U.S. Treasuries, particularly when rates are finally more attractive in your own country and you don't have to deal with any hedging risk. Short-term rates obviously is going to be driven by the Fed. I do think the Fed will cut twice this year. I think September and December will be the two meetings that they do so. But that doesn't mean, like we saw in 2024, 2024 when the Fed cut in September, that will mean lower long rates, because I think that we'll have another risk of higher long rates. We need all the help we can get in selling treasuries. Scott Bessent certainly understands that, and that's why he's taken more steps to induce domestic buying of treasuries. Now, over the last 10 years, foreign ownership of the U.S. Treasury market has gone from about 50% to today 30%. Now, a large chunk of that 10-year time frame was not just foreigners saying, okay, I don't want to own U.S. assets. It was, okay, well, treasuries are really not that attractive because interest rates are really low. I need to grab yield and take risk elsewhere, just like the rest of us did. So instead of buying treasuries, they bought agency bonds. Instead of buying agencies, they bought corporate bonds, where the Japanese were big buyers of CLOs. So that's why they owned less U.S. treasuries. Now, though, they potentially are going to own U.S. treasuries because they just don't want to own as much U.S. assets in totality. So now U.S. debts and deficits potentially can matter a lot in the eyes of foreigners. Now, on the flip side, higher interest rates in the U.S. has been a godsend for the domestic buyer, because now all of a sudden the saver can finally buy a U.S. treasury and get paid nicely for it, particularly the boomer set that has a big chunk of savings, and now they generate a nice amount of interest income from owning treasuries. So we've been able to sort of replace some of the foreign buying with domestic buying, which also implies that if the Fed starts cutting short-term interest rates, making T-bills less attractive, what does that mean for the rest of sort of the yield curve? And maybe short rates don't fall, or the 2-year doesn't fall as much relative to the Fed funds. So we'll have to see that. But I'm still a duration bear. I think we're in a bond bear market still. And I think there's going to be, over a multi-year time frame, a continued rise in long rates. But not just here. It's happening in the UK, it's happening in Japan, and it's happening in some other countries where debts and deficits are excessive. And the markets are calling out those countries that have those issues.
When we're, it's been interesting to hear the sort of political rhetoric around this, because now we're hearing a lot of talk about a shadow Fed, and they want those rates down, no matter what. They should be lower. Would a shadow Fed be able to do that? I mean, you're just talking about a Federal Reserve that's not really controlling the long end. They can only control the short end, and the long end's responding to fiscal conditions, responding to deficit conditions, and whether or not they feel that U.S. bonds are worth holding based on the political environment. That can the shadow Fed do anything to change that?
If you want to turn us officially into a banana republic, you create this shadow Fed. Now, Trump is not the first president to browbeat a sitting Fed chair. It's not the first time. But, if you were to ask Arthur Burns in his grave, does he regret rolling over for Lyndon Johnson, he would say it's one of his biggest regrets. And he said that publicly. So a shadow Fed is highly dangerous. Getting a Fed chair just to do your bidding and cutting interest rates just because, instead of the dollar index going from 96 to 95, it'll go to 75. And that happens, the amount of inflation that you'll import, and you'll see a 10-year yield of 5%, 6% if you get that kind of Fed chair. That's just cutting rates to satisfy a president rather than doing it because it's deserving based on inflation and growth. So I don't like, I want to see an independent Fed chair, even though, the Fed's still political. Alan Greenspan loved hanging out in DC political circles.
Yeah.
Lael Brainerd, when she was the vice chair of the Fed, wrote a $5,000 campaign check to Hillary Clinton in 2016. So you're always dealing with a political entity, but you want to see independence in terms of the decision making separate from what the president wants you to do. Yeah,
by the way, you lose that credibility. It takes a long time to get it back. That is not.
And the market will call you out for it.
Yeah. It's been interesting to watch that, because we know the playbook from before and the bond vigilante revolts of before and what it took to get that back under control. So it's sort of been an interesting conversation to watch, and we don't know how much of it is just jawboning and how much of it is real. So it sounds like you have a lot of concern about a lot of these different asset classes when we're looking at the U.S. Is there something, aside from the rest of the world, that you like? Is there something internally in the U.S. that you're finding attractive right now? You're a duration bear on bonds. Is there a part of the equity market do you like? Is it finally time, for example, for small caps to perform? Is there any positive on the economy that's coming from the spending bill that might be able to lift maybe mid cap to small, which have, again, been another trade that hasn't worked for forever, but we are seeing a little bit of a broadening out. How do you feel about that? Or is that a false start?
So I am really bullish on commodity stocks, particularly oil. I mean, I look at oil prices and I see OPEC raising production. A few months later, OPEC raising production. A few months later, OPEC raising production. So 411,000 barrel increases as they reverse the production cuts post-COVID. And then the recent one announced within the last couple of days, instead of 411, which is what the market's expecting, I think it was 548,000. Oil prices went down for half a day and actually closed up almost $1. When something doesn't go down on bad news, it's usually a bottom. When something doesn't rally on good news, it's usually a top. because there's something that's being missed here also is that U.S. shale is responding to low oil prices and concerns about demand. The U.S. rig count for crude oil is down 10 weeks in a row. The rig count of 425 is at the lowest level since September 2021. This is how low prices cure low prices, and it's offsetting OPEC's move back into the market. And I think there's tight inventories out there is what this is telling me. And oil in the 60s is dirt cheap. So I really like energy stocks. I continue to be bullish on precious metals. I probably said to you before that I started buying platinum last year, which has had a nice move this year. Ag stocks, fertilizer names. I like these hard assets in this kind of environment, and also just some other sort of idiosyncratic. I mentioned Macau and China. I've been lugging around these Macau casino stocks for the last couple of years, and it has been painful. But the numbers are looking better, and these stocks are having some nice moves here, but they're still very cheap. So there's cheap stuff out there. I think just investors, are just human nature inclined to just chase the cool stuff. Mm-hmm. And AI has been the cool stuff, and it's worked. And but I just think there's nothing wrong with sort of just, I don't want to say being creative. It's not that. It's just trying to find other things that may not have worked that have the potential of working, and because they're cheaper, there's less inherent risk. So there's plenty of opportunities within the U.S. I just think you just don't rush into the things that everyone else is rushing into.
Yeah, the herd mentality is so hard to fight, though, as you know, right? Because especially when you see a sort of rebound like that, and you feel like it's back on again. You mentioned some of the metals. What about silver? Silver comes up a lot in conversations because it sort of had a breakout. It's a different story than gold. It's less of that store of value. It's a little more exposure maybe to the economy. How is silver on your chart, or is that something you're a little bit worried about?
No, love silver. They do about half the demand for silver is industrial. So there is economic risk involved, but it more so trades with gold. And when you think about this sort of splintering up of the world, what are people wanting to get their hands on? It's these raw materials. And because everyone knows how important it is in this kind of economy, and the whole critical minerals rush of getting your hands on it. And I think there's going to be a premium for this stuff, whether it's platinum, I mentioned, silver, as you just said. These are important things to own, I think, in this kind of macro environment. So we're bullish, we're long, and silver $35 an ounce. It's still well below its nominal high, let alone its inflation adjusted highs.
You play in uranium at all? Because that sort of energy demand we know is increasing all around, but from hyperscalers, regardless of who you think is going to win the AI wars, we just know that technology is moving in that direction. Are you interested in nuclear? Does it feel like a crowded trade and a little speculative at this point?
So we've been long nuclear for many years now, and it's not early innings anymore. I do think that the big picture story is phenomenal, and that there's still a very wide spread between expected demand growth in the coming years relative to the supply. So we're long. I still like it. But, investing in commodities, you always have to, after a nice move in things like, Cameco in the 70s, we were buying it at $12. And when you see that kind of move, I get nervous. I want to be smart enough to sell when the right time, at the right time, particularly in a commodity. But, the story just seems so attractive from a secular standpoint that we're still hanging in there on that trade.
You just raised a question in my mind, and I don't know, maybe we'll have to rethink how we view this. But is the era of just sort of set and forget over? Like, can you just say I'm a long time investor, I'm just going to get this and I'm going to forget about it for 10 years? Can we even do that anymore in this kind of new environment we seem to be in?
Well, if you said that 10 years ago, that was the right decision.
Right.
because what a 10-year run we've had. The question now is, okay, is that repeatable over the coming 10 years? And with the S&P trading at almost 24 times earnings, I would say mathematically it's an impossibility. It's just a question of what your more muted returns will be.
Mm.
Now that's in the US, that's the S&P 500. There'll be plenty of other opportunities to make money. I'm talking about specifically the S&P. I think it's virtually impossible for it to repeat in the coming 10 years what it did over the last 10 years, just because we talked about the Mag 7 being totally splintered now, and therefore the market has to find other leadership. And with an S&P dividend yield, as we said, at 1%, I think we just could be in one of those multi-year consolidation phases.
Yeah.
And the money's not going to be made in the S&P. It's going to be made in other things.
Yeah, which means we all have to get to the drawing board, because so many of us have just relied on that sort of passive filtering it into something like an S&P index, or something broader. And so it's going to require, I think, a lot more sort of actively taking care of your finances and checking in on them and making
which means you can't close your eyes for the coming 10 years. You have to have maybe one eye open.
One eye. I feel like all of us have our nails dug in and are looking at it all the time, which I'm not sure we need to go that far, but it does feel like it's volatile and so much is changing that we do have to have kind of a completely different mindset. What about the hard asset theme? Is one that comes up all the time, and it's understandable in this sort of what feels like a very volatile period we're in. Is real estate in that for you? Is that something that you are also looking at? And if so, how are you expressing that? There's another area aside from the home we live in that I feel like not everyone has as part of their allocation.
So yes, so there are public REITs that we own that I find really attractive for a couple of reasons. One REIT we own is Weyerhaeuser as another hard asset play, even though that's sort of different. They're the largest private landowner in the US. I'm sure if you ask 10 people, probably most would not know that.
I'm rolling that out to my next dinner party. Peter, you always give me something like this.
So now they're very sensitive to the housing market. I mean, they have the timberland on the land that they own, and they refine that into finished products like lumber and so on. So they are sensitive to the housing market, and we know the housing market's been challenged here. So that's why the stock is down. But they also export product throughout the world, and as a hard asset, I think this is a great one to own, and it's cheap relative to what we see their net asset value. Now, on the real estate REIT side, what's very interesting right now, and this is actually for the last couple of years, you have the public REIT market and you have the private real estate market. Now, the commercial real estate market is about $20 trillion. Only about one-ish of that is public REITs. Most of the commercial real estate market is just in the private markets. And I find if you're going to invest in real estate, the public REITs are the ones actually right now that have the best balance sheets. They have the access to capital, and you get daily liquidity. And a lot of them are paying great dividend yields. So, and I love buying beaten up ones at cheap valuations. Like I love the shopping mall business. Kimco.
I thought shopping malls were dead. It was like retail apocalypse.
Well, this is the outdoor shopping center. It's more, I guess, a shopping center.
Okay, yes, totally different situation.
As long as you want to get a slice of pizza, and you need to go to the supermarket, and you want to go to the cleaners, and you need to pick up a bottle of wine at a liquor store, these outdoor shopping centers to me are pretty sticky businesses, and there's almost no new supply.
But weren't they so overbuilt? I mean, I feel like we both live in the Northeast. I feel like we call them strip malls. If anybody's seen the opening of Sopranos, like we drive past miles of this stuff and half them seem empty.
Pre-2008, there was a huge amount of supply. There's been almost none ever since. So when was the last time you saw them building a new shopping center? In the dense states, particularly the Northeast, you don't find it. Now you'll find it more in Florida and Texas and Arizona, but generally speaking, there's been very limited supply. So that's one area that we like. Now, shopping mall wise, Simon is dominant. No one's building any new shopping malls. In fact, you continue to see the B and C malls that are disappearing, or the B malls that are getting facelifts and continuing on. But the Class A, there's no new supply. Also, cold storage. Americold is a stock that's gotten destroyed. And finally, for the first time, it's attractively valued. That is basically owning exactly what it is, cold storage warehouses. So if you are a supermarket, you will lease space from Americold, will then temporarily store items in cold storage before it gets delivered to one of your supermarkets. That's been beaten up. It's got almost a 6% dividend yield. So the public REIT space has got some really nice, bond-like returns. Realty Income, letter O. One of my favorites is Vici Properties. We own that, VICI. They own most of the Las Vegas Strip. They own a lot of regional casinos that are leased to operators. And they also own sort of unique stuff like Chelsea Piers and some unique holdings. Bowlaroo. They own bowling centers. So experiential type stuff. They own some Great Wolf Lodges. They have deals with that I think is a niche, interesting area of real estate. And if there's one thing we saw post COVID, experiential stuff is where people want to put their spend their money on.
Yeah. It's interesting. So this is fascinating because this is an area that I think so many people think is toxic, that commercial real estate, extend and pretend, zombie.
That's the private space. The private area is challenged. The public REITs, many of the public REITs are much less levered, have much better access to capital. And multifamily I love. Even though right now rents are slowing to almost nothing, we are sowing the seeds for an acceleration in the back half of next year and into 2027 in rents in multifamily because we've had massive supply this year, but there's very little new multifamily building. And with home prices high, mortgage rates high, more and more people are going to be renting still. And Camden Property Trust is one of my favorite multifamily REITs.
Interesting. Is that Camden? Is that what I think? Is it East Coast base?
No, they actually have a very heavy exposure to Sunbelt states.
Oh, interesting.
Which is why they're currently under pressure because there's no rent growth. And in some markets, rents are actually down. But on the other hand, this is where the population growth is, the job growth is, and higher absorption rates, I think, are taking place. And it's extraordinarily well run. It's one of my favorite management teams.
That's amazing. This is what actually doing your homework looks like, folks, by the way. Like going in the weeds and understanding what these businesses do, what they hold, where they're based, is kind of the, in that 10-year period where there was no alternative, Peter. I think we all got away from that. Not you, but I think this is what we have to go back to. So that was fascinating. So wrap things up for me. And let's talk maybe about what worries you the most, or what is a risk out there and an opportunity. We'll start the risk that you think is the most underappreciated by the broader market or investment community right now.
So to avoid the hate mail, I want to emphasize that I'm all for lower taxes and deregulation. And therefore, it confounds me, this whole obsession with tariffs. And to me, that is the biggest risk to economic activity right now. And the numbers and the math that I do, the very basic back of the envelope math, and you don't need to be a math genius to take a tariff rate and multiply it by the dollar amount of goods we import to get a dollar amount and see we're talking big numbers here. And it just throws mud in the gears of business. That is my biggest worry right now. I think Trump could have coasted with the economy if he did not go down this tariff and budget deficit. I'm sorry, this trade deficit obsession, thinking that it's some. He wrote about it in the letter to the Prime Minister of Japan, but the national emergency of a trade deficit. And it's just nonsensical to me. So
Do you think the U.S. is at risk of recession?
With now 1% growth. Remember the days, Maggie, when 1% growth was knocking on the door of recession?
Mm.
Well, the first half of 2025, we have 1% growth. If the Atlanta Fed is right, and that we'll see 2.5% growth in Q2, because that follows minus 0.5% in Q1, and averaging that together is 1% annualized. So yeah, we're knocking on the doors of one. Now, we do have pockets of strength. Anything related to AI is robust. There is no doubt about it. Upper income spending, still very healthy. Anything related to government spending, still very good. It's just all the other offsets that I think in the aggregate is leading us to pretty punk growth right now.
And what about opportunity? You talked about some of the names you like specifically and sector-wise, but what do you think is the most underappreciated opportunity out there?
I mentioned commodities. I think that's pretty interesting. I would say that and is pretty much my most compelling. But still finding markets outside the U.S. that are still pretty cheap. I mean, take Vietnam. We're long Vietnam, and that's just been lugging that thing around. Has not been fun, but it's had a nice bounce off the lows in Singapore and another one. So I think that if you want returns over the next 10 years, widen out the lens here globally, and because there are a lot of opportunities.
And that's even with the threat of, say, these tariffs don't go away. You think they can thrive even under the threat of tariffs with the U.S. and potentially less trade with the U.S.?
Well, it's not going to help them. But, when you think about it, we're paying the tariff that we laid on Vietnam. So Nike, who moved their sneaker factories from China to Vietnam, is not going now from Vietnam to someplace else. They are staying in Vietnam, and we're going to have to pay more for sneakers. So I think Vietnam is still going to be a competitive place to manufacture, even with these tariffs. And who's actually going to suffer more? We are. We are going to suffer more from the tariffs we laid on Vietnam. So, and just to add one more thing, some people are calling that deal a victory because we're opening up the Vietnam market to U.S. products. The per capita income in Vietnam is $4,500. The average person in Vietnam is not buying a Ford F-150 because they can't afford it. Yeah. So the benefit of, we're opening up the Vietnam market to U.S. products, they can't afford it. And in fact, if you're going to damage their manufacturing base, you're going to make it even less affordable. So,
false narrative.
This is my big concern of tariffs, and I'm a pro-business, low-tax, deregulatory guy, and I just, like I said, the world is upside down when Republicans are pro-tariff and they like low corporate taxes, and Democrats are anti-tariff, but they want higher corporate taxes. There is an inherent contradiction in both of those viewpoints,
which says a lot about the state of Washington right now. Are you holding out hope that the tariff situation, I don't want to make it as simple as says go away, it just goes away, but there is this idea that maybe this is kind of like how Trump operates, and it's a lot of noise, and at the end of the day we'll just go right back to where we started. It sounds like you think we're not going back to where we started.
Well, all you have to do is look at the Vietnam deal, which is not even papered over yet. It's just a framework. I was hoping that the Vietnam tariff would just go back would be 10%. Now, well, originally, I thought it was a 20% on top of the 10 for a total of 30. And Scott Bessent was on CNBC today, said it's a total of 20. But 20 is double 10. So if Vietnam, who yes, we have a large trade deficit with, but that's because
they're poor.
That's just their circumstances. And they make a lot of stuff for us that we rely on. If Vietnam is left with 20, that doesn't give me much hope for the deals with other countries.
All right, something we'll have to watch out for. Peter, it is always such a pleasure to catch up with you. Nobody gets in there and knows the details like you, so we appreciate your time.
Thanks, Maggie. Always fun to chat.
And just a reminder to everybody, if you want to take a look at your portfolio and you need some help, go to wealthyon.com/free, and one of the advisors in the network will be able to give you a free portfolio review. So thank you so much for your time. We'll see you again soon.